So basically it'll just show my face then doing it this way.
Yeah, they'll still see your face on the screen and everything, so you'll be good to go.
Okay. I have it now. If you want me to share, but
Okay. No, I got this. I'm good to go.
okay. Cool.
This meeting is being recorded.
Hey, good afternoon, everyone. Welcome back to Financial Literacy Week, powered by U Mortgage. Thank you for joining us here on this Friday. We're very glad to have you. And we're jumping into our second session of the day. We have kicking off the day, first-time home buyers. We're going to be doing a second-time home buyers course today. And just a few things for awareness as we get into the session. As you joined in, microphones and cameras are turned off. The great way to communicate with us and ask questions, which we encourage you to do during this session, is to use either the chat feature, which is a tab at the bottom of your screen, and also another tab feature is the Q&A feature. So I'm very pleased to introduce Kyle Kohler. He is a loan originator here with U Mortgage, and just a great person to walk you through our second time home buyers course. So welcome, Kyle, and I'm going to pass it over to you. How's your day going?
Going great. Thanks, Ryan. I'm really excited to be able to teach this course. Second home is, kind of one of my my specialties here. I've been doing this long enough that most of my clients are second or third time home buyers. So let's just jump right in real quick. Now, I'm a licensed loan advisor. So this content basically is just made for training. I'm just trying to educate as much as possible for you. So this material does not take into account your particular, financial objectives, any situation or needs, and it's not intended as recommendations appropriate for you. In order to make the best financial decision that suits your needs, you should conduct basically your own research or seek advice of a licensed financial advisor if necessary. So, and you're more than welcome to give me calls personally as well. And I'm more than happy to go into your specific situation as well. So let's move on to the next slide and kind of let's go from there, and let's kind of focus on the topics of second time home buyers. So basically the goals I want to go over here is we want to first recognize down payment options that you have when purchasing a second home. We want to identify also options to sell and rent your first home if you want to do that. And then qualification requirements for second time home buyers. So we'll kind of go into specific topics there. Let's start with the down payment game plan. So there's multiple options that you have for down payment. So, there's different things you can do as far as, obviously everyone knows that the very first thing is if you save a lot of money, you can have enough for a down payment. So you can tap into your savings, save 20% of every paycheck, after a few years, you have enough for a down payment on your next home. Now, there's quite a different options you can use for a down payment on a second home. And this is with planning on keeping your first house, right? So obviously we jumped into savings. There's different options, and I'll go over kind of the few options there as far as, we'll just jump into it. Let's go to the first one. Is a lot of people can use their 401k as a down payment. Now, IRA is great for first-time home buyers, but most IRAs, you can't use that unless you can't draw from the IRA unless you are a first-time home buyer. So for first-time home buyers in the course we just took, that's a really good thing you can use. It also depends on the difference if you have a Roth IRA or traditional IRA. Check with your financial advisor what you can do if you can extract that out of your IRA and see what the penalties are. Typically there's usually about a 10% penalty on IRA, but 401k is actually pretty awesome because you can actually take out up to $50,000 and use that. And sometimes you can even use it for a second time home buyer. So a lot of people will ask, okay, well, how much is the down payment minimum on a second home? So let's say you have your first home. Do I really have to put 20% down? And honestly, no, there's two options you can actually use, and we'll go into that. So 5% down is actually a down payment you can use on a second home. I myself have always done 5% down on every new house that I buy, just because I know I can use other, my other 15% that I may have saved or other, options of the 15% that I have in my reserves or my equity. I can use that to buy investment properties, go into other investments. But every single time I bought in a house, like in 2019, I bought a new house. I kept my primary house at the time, and on my second home, I only put 5% down. And it was actually really good because in the scenario, The real estate agent was like, well, I prefer if you have a stronger offer. If you put 20% down, it shows that you're stronger candidate. But when I called the agent and I told him what I was trying to do in my scenario, as far as at this time, I was trying to buy investment property and my primary home at the same time. They actually really impressed them that I understood the market so well that I was able to get that offer only putting 5% down. So sometimes when you think, hey, 20% down is the strongest offer, actually, if you just educate and tell the seller, real estate agent, or the sellers what you're planning on doing, what you're trying to accomplish. In my scenario where I said, hey, look, I have 20% down. I can put that down if that makes you comfortable, but I really want to buy this investment property that I'm also pre-approved for as well. At the same time, it's not going to affect my finances whatsoever. I'm going to put 5% down here because I know there's low private mortgage insurance options. So I think at the time I put 5% down on this house and my PMI was like, I think it was like $72 a month. So it really wasn't that much as far as, I thought I'd love to have 15% equity to go towards this investment property. And I'm okay paying $76 a month. And I got to refinance a year later because my house appraised that extra 15% and got rid of my mortgage insurance. So I only paid about 9 months of mortgage insurance in my market. So it depends on the market you're in, but in my market, I understood the market. I understood where homes were heading. I knew the equity that I was going to get out of that out of my home. So I've only put 5% down. Now, if you are a home ready candidate, which this is a really cool program, it's called the Conventional Home Ready Program. This program has income restrictions. So if let's say you make, depending on your area, now in my area, it's roughly between $65,000 and $75,000 a year. Now, if you make in that area, you can actually put as low as 3% down on a second property and have 2 properties. Now, very specific, but if you meet that threshold, you can do that with what's called the Home Ready Program. So really cool programs out there, but you can put as little as 5% down on a second house that you're going to be living in as a primary. So it's not a second home like that's a vacation home or a second home, that's just down the street. And we'll jump into that a little bit different. But Ryan, if you want to skip ahead to the down payment minimum slide, let's go and kind of jump over there. So, less than 20%. Now let's go over kind of those options that need to be 20% down if it's a second home. So like I said, if you're buying a second home and you want to live in it, then you can put as little as 5% down because it's going to be a primary home. And then your other house can be, my other house, I think was like 20 miles away because it's a primary. Now, if you are going to be going and buying a second home that's basically kind of a vacation home, you have to be within at least 50 miles away, or if you have to get an exception. So it depends. So if you live near, like, let's say I'm from Utah, let's say you're Park City and you want to buy a second home in Park City, but you're in Salt Lake City where you may be only 26, 27 miles away, you may be able to get an exception just because of the area and what it is. But typically, if you want to buy a second home and it's called second home financing, you're planning on living in your primary, you're going to need at least 50-mile radius from your primary house. And also you're going to need at least 10% down if you're not planning on living in that house. It's just a second home. It's a vacation home. So let's say, I'm up in northern Utah and I want to buy something in southern Utah. It's like 300 miles away. I'm going to have a minimum 10% down on that payment for that second home because I'm not planning on to live in it. So quick recap. If you're planning on living into your home and you want to keep your home, you can put 5% down every single time you move into a new home after you've lived in that previous home for a year. If you're not going to live in that home, it's a second home, you're going to want to put as little as 10% down. And if you put 20% down, you're going to get a much better rate than you do 10% down on a second home. So that's kind of the difference between, hey, I'm going to buy a second home, but I'm not going to live in it. And I'm going to buy a second home and I'm going to live in it. So saving for a down payment. So let's kind of go on the different options of saving for a down payment. If you're planning on, again, this is if you're planning on keeping your current house. So you bought your first time, your house for the first time for a few years, you're ready to buy a second house, but you want to keep the first house. So obviously we know savings works. There's different options as far as what you can use in this. I would say the one that I see the most is a home equity line of credit. So how a home equity line of credit works is your local credit union, banks usually offer this the most as far as in my local area. You can up to 80% value, some are even up to 90, depends on the bank. You can withdraw from there your down payment. So I had a client a couple weeks ago. They had enough equity in their house that they wanted to keep their home, and they wanted to, they didn't have anything saved. They had a little bit of savings, but they didn't have enough to put on that 5% down on their new house that they're moving into. So they took out around $70,000 of a home equity line of credit against their first home, their home that they're living in now, and they're using that to buy their new home that they're moving into, which will be their second home. Now, here's the game plan that they have to go by. So this HELOC now is second lien to the property to the first mortgage. So their first mortgage balance is like $330,000. Their second balance is about $70,000. Now they're going to have a payment, and it's about the same as an installment loan. So like, let's say you have a $70,000 car. It's going to be about the same payment as that, is, just so you can kind of budget, but you can find out what your budget's going to be. And then typically a HELOC is going to be either a fixed or a variable rate. So go over those options when you're getting that set up. And then what I do is, as a loan officer, is I make sure, okay, well, the next step is, how can we make sure that you qualify with not only your current house, but your current HELOC and your new house. Now, what's really cool about that is there's two options I can help you qualify for that. Is, the first option that I can help you with that is we can get a projected rent schedule of appraisal on your current property. So basically what that is an appraiser comes in, they evaluate what the home is worth and what the rent would be on that current house. And then they can offset that from your debt to income ratio, because they know that market value, you're going to get a contract for that primary house to cover your mortgage and your HELOC. And I try to make sure that you cover both of those too. Or the second thing you can do is you can get a lease agreement with the renter, upcoming renter. All they need to have is a deposit, and I can use that lease agreement to offset whatever your mortgage is on your primary mortgage, so that you can, it's basically the same as if you're paying it off, right? If you pay off that mortgage, like a traditional people usually pay off their mortgage to use for the down payment on their new home, and then they pay off that house. No, I can offset that debt to income ratio with the lease agreement, because the new renters are going to cover that mortgage payment for you. Now I can use that up to 75%. So we want to make sure that the rent is, about 25% more than what the actual mortgage payment is, to be able to offset that for you to break even on that property. So a lease agreement works, and you can use the HELOC for the down payment. Now that helps with, let's go to the next slide, Ryan, for contingency offers. So that helps a ton. So they don't have any contingency on this offer of this current client that took out the HELOC, because I helped pre-approve them with the lease agreement or a 1007 appraisal from the appraiser, basically saying that, hey, this is what the rental's going to come in when you get your agreements. They now don't have that contingency that their house needs to be sold to buy this house. So that helps them have a very, very strong offer to be able to get the house that they want. Now, according to what, they want to have this be a long-term rental, so that works out. But at time, sometimes people will just do that to get the house that they want, and then they'll rent this other house out for a year, and then they sell that house. But it makes it so that this specific offer doesn't have a contingency. So it's a really cool opportunity to be able to put in the strongest offers available. And what's really cool about this as well is, let's say you want to have a better payment on your next house that you buy. So you have your first house, it's a rental, you have the HELOC that you took out on it. There's two options you can do after buying that new house. So option one is you can put this into contract, have a renter for a year, and then you can sell the house and put it back into your new house a year later. And what you can do is recast your loan. It's called recasting. You don't necessarily need to refinance, but you can put whatever equity is in that house and put it into your second home, and then recast it to get to where you want your payment to be at that moment. So there's definitely different ways we can do that. Or quite simply, sometimes you don't have to take out a HELOC. Maybe if you're able to just handle both the mortgage payments, I can basically get you pre-approved on your primary house and your new house. And as long as you're moving in your new house, all you need to do is put 5% down. And then what's amazing about that, no contingency, you don't need to sell your house. You can figure out anything you need to do as far as just winning that house, and we can take it from there. So that's what I did on my property. I didn't need to get a lease agreement going. I didn't need to get a renter going. I just was approved for both homes. I could put as little as 5% down. And we'll get into, if you want, Ryan, want to move to the bridge and home equity loans real quick, the difference between the two. So they're fairly similar. A bridge and a home equity loan they're both similar. Kind of tell you the difference between the home equity loan and the bridge loan. So typically the bridge loan is they're maxed out at what's called a combined loan to value ratio of 90%. So I'll give you an example on this. So let's say you own a house that's worth $300,000 and you owe $200,000 on that. Now on a bridge loan, I can use up to 90% CLTV. That's your combined loan to value. Basically, that's 90% of $300,000. So that's $270,000. So now, since you own $200,000 on your primary property, how we do the math there is, well, you can go up to 270 as far as the max bridge CLTV is, amount. 270 minus 200K on the first mortgage, you have roughly 70,000 to work with on your bridge loan to have the down payment on the new residence. Now, typically with bridge loans, you got to be approved with the primary residence plus the bridge loan plus the new residence. So we got to make sure you're approved on all those, and same with the home equity loans. But they're very similar to what's called an installment loan. They're not necessarily a mortgage loan. You're going to get them a lot quicker. As far as it's not getting a home loan is very extensive because we have to collect your income documents. We have to make sure you're approved. We have to make sure everything's good to go, because at the end of the day, we want to make sure that you're going to get the house and you're going to be able to, perform. This loan of yours can perform on the secondary market. Fannie and Freddie's going to like it. Everything's going to be good there. But these are just installment loans, so they're a little bit different as the way that they're underwritten. And so that's just basically, long story short, the two options you have in order to be able to have down payment on your funds is a bridge loan, home equity loan. So you also can do gift funds as well, because you're going into a primary residence. Every time the rules apply. So as long as you're moving into it as a primary, it's the same every time. So you could do as little as 5% down on those homes. If you're, if I could go back in time and be a 23, 22-year-old that's working really hard, and I didn't have much, maybe I had a baby. I now have 4 kids, but I don't have much kids, so it's not hard to move. I would buy a house, live in it for a year, and then I would save as much as I can, maybe do a home equity line of credit. Just draw out whatever 5% down would be. I would move into my next home, and I would do that for 5 or 6 years, because as long as you live in it for a year afterwards, you can turn that, it can be an investment property. So it would be an amazing opportunity. I could have, looking back, hindsight, right? I can basically have 5 or 6 investment properties as long as I'm saving or using the home equity and the equity in my home on every single primary house. So I have a client that's done that. He started at 23. He's now around 31. He has 5 properties now in his name, and he's only put 5% down every single time. So it's pretty amazing. And he didn't even save money on these. He didn't save money on every paycheck. He just took out a home equity line of credit every single time when he saw that his home was building equity on every primary house he lived in it for a year or two, and then looked for the next home and moved into that next home. So a lot of cool options you can do. You don't necessarily always have to put 20 or 25% down and wait for the next investment property. And you could still do that. I could still do that for me, but I just uprooting my kids different schools. It's a little bit harder, but younger people, or maybe if you're okay with moving around and doing that, that's another option you can definitely do. Let's go to the next slide, Ryan, on FHA, second time home buyers. So if you have an FHA loan, you can only have one FHA loan at a time. You can't go from an FHA loan to an FHA loan. So if your primary residence you have now is an FHA loan, you either have to refinance that property, or you can get a conventional property on your next property. So you can continue to have that FHA property for the rest of the loan. I would never recommend keeping an FHA loan for longer than 2 or 3 years, just because FHA is a great first-time homebuyer program, because it helps lower credit score individuals have a lower payment, because typically the rates are a little bit lower. But the one caveat to FHA is it carries private mortgage insurance, just called PMI. It does not drop. So conventional, it drops after 80 LTV, which, basically, long story short, once you have 20% equity in your home, it'll drop. FHA is there forever. So it's 0.85%. So for example, let's just use $200. It's going to be $200, for the life of the loan. So either the option you can do is you can refinance your primary into conventional, And normally you're always going to want to do that because you cannot get a HELOC with an FHA loan on your primary property. You can't. You have to have a conventional loan. So you'll want to refinance your FHA loan into a conventional loan when you can on your primary, or simply if you're going to buy a second house and you have the funds to buy a second home, that second home has to be a conventional loan. So just so you know, FHA is a great one. You can only have it one time, one property at a time. So let's jump into the next slides of buying before selling best practices here. So, you know, the best practices, it all kind of depends on your market. I think I really think it depends on, you know, is contingencies a huge thing in your market? So if contingencies are a big thing and people are really, really wanting to not have to wait for you to sell your house, then, you know, I think in that scenario, what I've been doing is making sure that you can get all your ducks in a row with your loan officer to make sure that, okay, can I be approved for a HELOC possibly? Can I be approved for both homes with my existing home and the HELOC and the new home without a rent 1007 schedule, appraised, basically a rental schedule or a new lease agreement? You know, go through all the options, and let's say you can be approved for everything and you don't have to worry about it. That's a great practice to have, you know, to have all your ducks in a row and know what's the game plan. Because maybe you have to have a lease agreement. So maybe you're going to have to find a renter before to make this work. So make sure you have your ducks in a row before you're selling your house. That's the biggest thing I'd say. Another thing is if you're planning on selling your house or planning on buying another house, make sure, you know, try to be 60 days ahead of the game at least, or even sometimes 3 months. I'll have some clients call me to get a game plan going, because we can help you get your credit score up. So, and right now it's very important in this market to have a credit score of 740 or higher. And I like to say 760, because 740 is the highest score in the mortgage market that you can get if you have 20% more down. Now, if you're less than 20%, you're putting 5% down, the best score is actually 760 for conventional loan, because 760 is what is also optimal for a credit score for your private mortgage insurance. Because if you put anything less than 20% down, typically you can do, you're going to have mortgage insurance. There are programs that we offer that's called lender paid mortgage insurance. So for example, you know, you go, let's say the rates, let's just use rates for example. These aren't the current rates, but let's say 4.5% is the rate and you have $75 of mortgage insurance. The lender will offer you a product that's saying instead of 4.5, you can do 4.75 with no mortgage insurance, and you put little as 5% down. So historically, they've been doing that in the last few years, but in this current market, it's a little different just because of the way rates are. But that is another thing that you can do. A good practice is, okay, well, I could put 5% down, do lender paid mortgage insurance, and not hold mortgage insurance. But typically, you're going to have mortgage insurance on that, so you're going to want a FICO score of at least 760. So I coach my clients when they're getting ready to sell or getting ready to put up a lease agreement, buy that second home. Please, let's get you to at least, depending on how much you're putting down, 740 or 760. That's what we're going to work on. And you know, for other programs that we have, whether it be, you know, a VA loan, which you can only have one. You can have 2 VA loans at a time, but you got to make sure that you have enough entitlement to be able to do that, and it's got to be a fair enough distance. Sometimes it's got to be state. It's got to be a, you know, let's say you're living in Utah and you want to move to Vermont. You can definitely have a VA loan in both markets, but you got to look at your entitlement to see how much you can, you know, finance for that VA loan. So talk to a VA specialist. We have any VA specialist, myself, a VA specialist as well, but we have a lot of VA specialists in our office and a lot of VA specialists nationwide. I can get you directed in your market that can kind of tell you about the VA part on there. But you can do that, but you got to make sure, you know, distance is key in that scenario. But for conventional, which we'll focus on right now, best practice is just getting your FICO score. You're going to want to get that optimal. You're going to want to make sure. Another thing that I needed to recap is if you're going to keep that house and you have a lease agreement, if you're putting 5% down on the other property, we may want to draw a little bit more on the HELOC, so you have up to 2 to 6 months in funds, depending on what the automated underwriting system that I run through Fannie Mae to approve you for both homes. I'll approve you with having a home with a rental, basically turning it into a rental, but we got to make sure we have reserves for that rental just in case. So you're going to want to have at least 6 months of reserves on top of that next down payment on the next house. So that's another thing, you know, just getting your ducks in a row for that. And then just figuring out different different scenarios you can do. So, looking into, okay, well, do I want to buy this house conventional? Do I want to move into this house? Do I want to have it a second home? Do I want to make it maybe an investment property? You can still live in your home. If, let's say, you love your primary home, but you want to buy a second home, you can still move into, a different property doing investment. And we'll jump into that real quick. Can you jump, Ryan, into, what if money is tight and strings attached real quick? So if money's tight, you always want to make sure that you can talk to your local loan officer to see where you're at, because we're going to figure out what is the debt to income ratio we need to do to pencil this in to make this work. What lease agreement do we need to make sure? Maybe the lease agreement needs to be $200 more a month for rent to be able to make this work. Maybe, another thing I put in this scenario is a lot of times, maybe you don't want to be a property manager. So on my rentals, I always make sure I have a property management group that's really good, because they can take care of it for me. It's really nice to have a property management group, find the client, find the tenant, any issues arise in the house, they take care of it for me. I just don't have time to do it. I get attached to people too. And a lot of times, for me, I will look at it much differently than an actual, property management company. If they're not making their payments on time, it's their judgment call on what they can do for this renter. Now, as far as I go, that's not what I am. I'm a mortgage loan officer. I'm not a property manager. So if you're good at that and that's your strength, I'd highly recommend, finding out what your strengths are there and finding a property management company and telling them, hey, look, I need to find rent maybe $200 more a month to pencil in my debt to income ratio on this. So we got to make sure that lease agreement is looking really good. And we also got to make sure when you draw the HELOC on your home or a bridge loan, draw that first. You're going to want to take that out a month before you're going to be buying the next house. You're not going to want to be doing it simultaneously, because we don't know what the actual rate and term will be on that home equity line of credit or that bridge loan. So if I can see what the rate is and what the payment's going to be, and it's already populated in your credit, then we can get you pre-approved and make sure, hey, look, you can definitely draw out $70,000 or $80,000 on this home equity line of credit. Your debt to income looks great. You're good to do that. So don't don't just pull the trigger at the time of buying the next house. Make sure you have this ready and have a solid game plan moving forward on that. Making a strings attached offer. So let's kind of talk about the string attached. So this approach, it works best when sellers are most likely to get multiple offers. And we know in this market, sellers are getting, at least in my market here in Utah, they're getting a lot of offers. I've seen, on average between 15 and 40 offers. So, making sure that you can try to basically have as less contingencies as possible to win this house is pretty awesome to have. So, being able to keep your first home and not have that contingency that you have to sell your second home can be something really great to have. Now, the seller can also seek other offers. Cash usually is what they want, is king, but a lot of times they'll see if there's no contingency on the offer, your offer is just as strong as cash. So that's kind of all I wanted to mention on there, is just, just make sure you can see if you can avoid contingencies in this market. And that's the game planning is the most important thing, is what I've mentioned before. Let's go into the next for asking on a cushion, Ryan, here. So when you're asking for a cushion, so basically, are you confident that your current home will sell quickly, but still need a little extra time to pull together a down payment and closing costs for a new place? Ask to push out the closing date of the one you're buying. So I know this way you can have some profit sell from the first home to cover the financial requirements of the second home. So again, this approach usually works best in a buyer's market. Obviously, we're not in a buyer's market. In my market, we're in a seller's market. So I usually typically don't advise asking for any sort of cushion on there unless your offer is incredibly strong. I've seen offers that are very, very strong where maybe they waive the earnest money right away. So the earnest money's goes hard within acceptance. It's a really tough thing. You got to make sure if you are going to have, I've seen up to $50,000 earnest money hard up upon acceptance, and that's gone. So this has to close. This loan has to close. So a little more stressful, but because I make sure my client has all their ducks in a row and that they're for sure approved on this before that earnest money, goes hard, we know we can close that, and we're not going to ask for a cushion in time. We're going to close that on time. We're going to try to close early because it's a seller's market. Just make sure you know for a fact if you're going to be risking that earnest money, you can get this. You're pre-approved for any sort of scenario as far as what if my house doesn't sell, if I have to get a lease agreement and have to rent it. Make sure you have everything in front of you to make sure that that's going to be okay. Because in a buyer's market, you could probably ask for a little more cushion, but a seller's market, there really isn't much cushions going on right now. So you got to be a competitive. You have to be, urgency is kind of the biggest thing right now. You got to be able to be available to close as quickly as possible and has as little as contingency as possible on this. So tap into your equity. We kind of talked about that, these next two slides, Ryan, we kind of talked about this a little earlier. I kind of jumped the gun a little bit, but again, I tap into my home equity a lot for a down payment on the second home if I don't have the savings. It's a great way to have a home equity line of credit. You can only get a home equity line of credit drawn on your primary property anyway. You can't do it on investment property. So when it becomes investment property, you're gonna be really happy that you opened it. So a lot of times I'll even open a line and only take like $1,000 out. I may be able to draw a lot more if I want to, but then I can use that to draw in the future for other, other purchases, other investments. So using a HELOC is probably, I would say, the most, I'd say the lower payment between the bridge loan. A lot of times the bridge loan's only between 6 months to a year. You're gonna want to pay. That's kind of the terms there. But a home equity line of credit, can be, up to, 5-10 years, a lot more, kind of like an installment loan, right? Getting a car loan. So you have a little bit more time to either pay that off or, be able to tap into that is the biggest thing, I think, is being able to open that. So if you have a primary home right now that you've been living in for 3-4 years, I'd highly suggest checking tapping into equity for a HELOC. If you have an FHA loan, I'd highly suggest taking to look into a cash out refinance. So you can refinance your house, cash out, take the cash, the equity that you have. And as long as you have 80%, LTV, which is again 20% equity in your home, you can cash out up to 80%. And a lot of times, I even in this current environment, we're still doing cash out refinances for people that are, it's still making sense for them. So you can do a HELOC or you can do a regular cash out refinance. The difference between a cash out refinance and a rate and term refinance is a rate and term, you're just changing your rate or maybe your term as well. Maybe you're going from a 30 to 27 year, 30 to 25, 30 to 15 or a 10. Cash out is you're drawing the equity that you have in your house and you're using it for other purposes. So you not only can you do a home equity line, you could also do a cash out to be able to use that funds to purchase another home. Let's go to the next slide for rent out your first home. So we'll kind of recap real quick on this, on renting out your first home. So there's two options here to be able to use this to be able to buy your second house. So it's called the rent schedule appraisal. It's an appraiser comes out, tells you what the rent value will be. We can use that or lease agreement. And you're going to want to make sure on the lease agreement that you have, I can use 75% of what the actual rent's going to be. So you want to make sure to have 25% higher than what your mortgage is so I can offset it. Or, if you can't do that and that's what your market says, the only hit you're going to take on that mortgage instead of 100% on the mortgage payment against your debt to income, only 25%. So there's a lot of good things as far as renting out your first home. And my suggestion is look at your strengths on your home. If you're going to be renting it out, do you want to hire a property management company or do you want to do it yourself? Or a third option you could do, depending on your market, if it lets you, are you wanting to turn your home into an Airbnb, which is a really, really cool opportunity. You can do that. I have multiple people in my office that have done that. It's a very different game. It's not, if you're going to turn it into an Airbnb, you're going to want to make sure that I can't use that to offset your debt to income on your second home for financing. So you want to make sure if you're going to turn that into an Airbnb, we got to make sure that you're approved with that mortgage regardless. So if you're approved with that mortgage and you don't need a lease agreement on that house, you can essentially turn that into an Airbnb. And that's another cool thing as well that people have been doing. And I highly suggest, again, if you're going to turn it into an Airbnb and you don't need a lease agreement or a rent schedule, basically to show that you can offset your DTI, get a property management company to cover that for you. So multiple ways you can rent out your first home to be able to use that equity, but make sure you have your lease agreement in place. and make sure you talk to the right professionals. We always will. You're not going to want to draw out your own rental agreement. You're not going to want to, you're going to want to go to the right professionals in that. And we have many professionals that we can turn to that have great agreements that we can give you as templates to use to protect you and protect obviously the renter as well. Or property management companies are usually the best because they have the best of the best there. Now, with renting out your first home as well, you're going to want to make sure in this scenario that if you're doing it yourself, you're going to want to have the right professionals that you can help figure out what their credit situation is. There's a whole application process for renters that we can help direct you as well in your market if you want to do it yourself. Again, it's all about your strengths and what's best for you as far as what you can do. I have a couple of friends that are just rock stars, and they're their own property managers, and they manage 5 or 6 properties that they bought in the last 5 or 6 years, and they're killing it. Yeah, let's end it with any questions you may have. Ryan, if there's anything here, let me know, and we can kind of go over, any questions you may have on having the second home financing workshop.
Yeah, thanks, Kyle. We'll open it up. No questions have come in currently on our chat or anything, but actually one just popped up right at the moment here. So
nice.
Bradley asks, when using traditional pre-tax 401k funds for a down payment, is that money treated similar to a 401k loan? In other words, do you have to pay that money back to your retirement administrator? I would assume so, to avoid being taxed on the distribution.
Yeah, I mean, I think either way, there's going to be some sort of prepayment penalty that you'll have to pay for, or you'll have to pay that money back through the, whatever terms it is. So I would make sure to run that by whoever is in charge of that 401k and let them know, hey, look, I want to draw this out. What are my prepayment penalties here? And do I have to pay this back? And they'll give you the options, because sometimes there aren't penalties depending on the 401k set up. It just depends on that, the way your 401k was set up. So great question there. But I think from what you said, you'll probably have to pay that back.
Awesome. Thanks so much for taking care of that, Kyle. Another message came into me actually, and they're asking, is there a certain time period I have to wait between, say I buy a primary house and now I'm thinking, maybe I joined this session and thinking, I want to buy a second home. Like, is there any time period stipulations?
As far as just like a seasoning to have your primary house to a secondary house?
Yeah, I think it's just asking like, is there any broad question, but is there anything that exists that stops you from getting a second home once you have a first one?
Yeah, so when you sign on and you buy your first house, you sign that you're planning on to live there as a primary residence for at least 1 year. Now, I've had a scenario, and and sometimes it happens, but I had a client that bought a house. He bought his house in I think April, found out that he was getting let go, and then he had to move to a different place. And he didn't want to leave the state, right? So that's why it was a little bit different. He found out he had to move about 75 miles away. And at that point, it was up to the underwriter, but he was actually able to move about, I think it was like 52 miles away from his house that he bought in April. He was able to buy it in December. It was under the underwriter's discretion in that scenario, but he did the same thing. He pulled out a HELOC. He bought the house in December, but his was because of the job situation. So it's going to be a 1-year period that you want to stay in that house, minimum, unless there's something happens. Usually it's something like a new job situation, or maybe his wife, someone's wife loses, has a baby, and he was remote, and now he has to be closer to his other, his HQ, to his office. There's got to be some sort of, life event that happens to be able to work within that 1 year. But typically you're going to want to stay in that primary residence for 1 year, and then you're free to do what you please after that first year. If you want to, buy a second home. Did that answer it? Is there anything else in there, Ryan, that
I think that looks great for our question. Thanks for taking care of that. And then Alex popped a question in our chat here. He says, I know this isn't financial advice, but I don't want to overpay for a property. What are your thoughts on the market currently?
Yeah, I mean, I'm the same way. I mean, you obviously, it's always penciling in your return on investment, right? So, I mean, if you know the market really well and you know what you want to do in leveraging, your current debt that you have. So, for example, there's 2 options on the top of my head I can think of on this one. So, And I'm going to give a shout out to Adam West. Adam West is a guy in my office. That's awesome. He is in the same kind of pickle there, right? He's like, man, I don't want to buy these homes for this price, because it's a lot of money that he's buying his next house he's moving into, and he doesn't like the mortgage payment. But what he ran the numbers on he bought an investment property, and he's turning his primary into an Airbnb. And he's running the numbers between what he's going to get on the Airbnb and on his investment property. And he's at, the mortgage payment that he has to pay is roughly $2,000 more than he wants. But with these other properties that he has, he's just like, you know what, I'm going to buy this property even if it is a little bit more, because it's penciling in really well for him. He's only going to have to come up with like $1,500 because of these other investments to pay for this new mortgage. So his mortgage is actually going to be about the same as what it is now on his current house from the cash flow that he has. So that's kind of the first thing I'm thinking about as far as being able to leverage that. Just kind of, I don't want to pay more, but that's just kind of what the market is. But making sure, if you have different homes, penciling in, the rent that you have to be able to cover that, because both his properties will cover a lot of that mortgage, and he's going to be good. And then the second thing is, if you can't do Airbnb and you can't do that, just make sure if you have the lease agreement, if it makes sense. So let's say in your area, the rent on the lease agreement on your primary property can cover not only your mortgage, but an extra $300-400, sometimes even $500 a month. Maybe you're cash flowing on that. Remember that $500 is extra to you, right? So trying to use that to help on the new property, to be able to just see, okay, yeah, my payment might be $300 more, but I do have this $500 to work with. So it's just more of just understanding the extra cash flow you have from your primary lease agreement. So maybe you'll have to get a lease agreement that's $200 more. Maybe it might take a couple more weeks to find that renter that's willing to pay an extra $200. Maybe you have to do something to your property to make it a little bit more, maybe you have to update a kitchen or something, or a bathroom to make it a little more appealing to be able to make that work. But hopefully that answers that question. Is there anything else? Where's the notes if I can see if I answered that correctly for him?
Yeah, that was in the chat, Kyle. If you click on the chat icon, you'll see that one pop up from Alex. But I think you did a great job with that one.
Yeah.
Alex, let us know too.
Yeah. No, Alex. So I mean, I know it's not financial advice, but it depends on, overpaying for a property right now. If the property makes sense for me, so for example, if I'm going to buy the property and I'm overpaying for it, I'm going to make sure that I'm going to do my research on the area. So when I bought my house, I thought, you know what, this is a little more than I wanted, but I knew that area was going to appraise really well. I knew the equity was going to be great, because I just know my local market really well. I knew for a fact that if I bought this house, that within a year or two, it would be $150,000 in equity, and it is more. It is for sure. It's more than that. So knowing your market really well is the first one. And then I also knew if I was ever going to turn this into a rental, I knew this rent would rent really, really well, and it would pencil in whatever my mortgage plus some. So it'd be more than what my mortgage is, and I'd be breaking even and making a little bit more money on that property. So it all depends on, is the house worth it? Will the rent be worth it in the future? Is an area I really want to live in? Like, do I really want to live in this area? If all those are yes, then, maybe you can justify overpaying, but it all depends on your market, knowing your market, and what you personally feel in that situation. Because there are some areas, I'll be honest, I'll look at this, I'm like, I just can't, I'm not going to overpay for that, because it doesn't pencil in all the things that I want. The rent's not going to cover what I want it to do. My mortgage, I'm not going to break even on my mortgage there. I'm going to be losing money on this property. So make sure you know the market and the area that you want to buy to see, okay, well, if I am willing to overpay, am I going to be covered if I turn this into rental? Is the equity going to take care of me in this property, in this area? And if the equity can take care of you, like for example, if the area is consistently every year equity is going up in that property, then maybe it makes sense. And then also talk to your loan officer, see if payments, does it make sense to buy down points? Sometimes it makes sense to get a little bit lower rate by buying down points. There's a lot of different things that you have to look at depending on how long you want to live in the property. So hopefully that helped out. Is there any other questions we have, Ryan?
Yeah, there's actually two. Alex followed up in the chat, and he's just asking, do you see the market kind of cooling off at all? He says, like, worst case scenario would be having a mortgage $50K more than what the house is worth. So I think, thinking a little bit back to maybe like 2008, some of those things where, housing values dropped. And I know, if anybody could predict this,
I'd be a really rich man.
if you could do that. Yeah. But any thoughts on that?
Yeah. So right now, the Fed's trying to control inflation right now with hiring the rates. So, that right now it's slow burn. We're going to see if it works. But I know for a fact we're not going to see any sort of bubble burst. We're not going to see a crash. The only thing I think they're trying to correct is, for example, I'll give you a specific one. In 2019, I bought a house, and we're in 2022, and my house is appraised more than, I think $300,000 in the last 3 years. What they're trying to control is that's just not normal, right? What they're trying to control is I buy a house in 2019, it's 3 years later, and I built, $65,000 to $75,000 in equity. That's what they're trying to control. So, that's I think is a little more healthier, because right now you buy a house, 3 years happen, in my market, you get $200,000 equity after only a couple of years. That hasn't been historically. Usually it takes, over years, a span of, 10 years, it takes you to get $300,000 equity. So I think that's what they're trying to do there. So no one's going to be, under, let's say to buy a house and it appraises low by 50 grand and they pay, 50 grand over. I don't think that house a year later is going to be, they're not going to be underwater still. I think they're going to be okay. I think after a year, they'll still have that. I think it'll appraise 50,000. It's just not going to appraise 100 or 200,000, in a year, which we've seen some houses. So hopefully that answers your question, but the equity game is just not going to be as fast. They're trying to control it to be a little bit more, steady, instead of just buying a house in 2020, selling in 2022, making a huge profit. That's just, they're trying to control that.
Right. Thanks so much, Kyle. We actually have one more question come in our Q&A, and a really
Awesome.
good one here. So for those of us not interested in keeping our current home as a rental or an investment property, do you have any advice to avoid renting like something like a storage unit, living in a hotel, or going back to your parents in between homes? What confuses me the most is the timing of everything. I know you talked about cushion, but it's hard to grasp without actually experiencing it.
Mm-hmm. So it's basically selling your house because it's the right time to sell, but then having a hard time buying that first house. And so you're kind of stuck in limbo, correct?
Right. Yeah.
Yeah. I mean, it all depends on what's your game plan of what you're trying to, or what's your scenario in your life. So, I mean, obviously if I'll give an example. I have a client here that sold their house in Utah because of a job. It was the right time to sell. They actually ended up renting for a little while out in the East Coast, and they found one that was 6 months agreement, and they're just going to be shopping for the next 6 months. Another one found for a year. I would probably, depending on the market you're in, and depending, in my market, I probably wouldn't suggest doing the hotel thing. It could be 30 to 60 days, depending on the house you want to find. It's got to be the right price range. Now, for example, in my market, so let's say you sell your house and you're in limbo, but you want to buy a house in the $450,000 range in my market. You're going to have to realize that in my market in northern Utah, $450,000 house is going to have 40 to 50 offers every single time, maybe even 100 offers. And so you got to realize, okay, how am I going to win on these 100 offers? Everyone's going to have a pretty strong offer. Chances are you're going to probably want to be at a place that you're not paying rent at a hotel daily. So, but if your price range is a lot higher than that, you're seeing, with a higher price range home, you're seeing less offers. So, it just kind of depends. If you're looking at over the million mark, they're only getting, 5 to 10 offers. Then your chances are much better because you're only competing with 9 to 10 people instead of 40 to 50. So maybe living, I've had clients that have to live in a basement. But if you're really proactively looking for a home, and my advice here is, if you're in the need versus want market, if you're in the need market and you're like, I need a home, and you're going to be aggressive, then just be a lot more aggressive, because depending on if you don't, if you want to live with your mother-in-law or wherever, if you really don't want to live where you want to live for the time being, just be incredibly aggressive on your offers. Now there's no contingencies because you have cash. Finding a loan officer that can close in 2 weeks, have a really good offer. Maybe you have cash completely to be able to pay off the house, and then if you want to keep the house later, you can refinance and do a cash out refinance afterwards. People do that. Having the most competitive offer while you're kind of on the fence, right? You're not in the right place as far as, I don't have a long-term place. Just urgency is going to be key for you. And it all depends on just knowing your market. So if whatever market you're in, just realize, talk to the right real estate professionals, right loan officers, and be like, hey, what's the average day is, our homes on the market? How many offers on average are you getting? Just kind of understand where you're at, and then make that decision of, okay, well, if the average market of the home I want to buy is 40 offers, I definitely don't want to be doing the hotel thing. Or you may want to be doing something where you could stay with a family member for a little while. And as far as a storage unit goes, there are pods. They're called pods that you can rent that are really cool, that you can put in front of your house or in front of your parents' house or in the driveway. Obviously, run by your parents. My dad would be super ticked if I did that to him. But you can do storage units for a while. There's different avenues out there that you can use depending on how much storage that you do have. But typically, what I've seen is if you're putting in very urgent offers, it's going to be a 60-day wait probably is as far as worst case scenario that I've seen. I've seen people still be okay and they sell their house, and maybe it's a 2-week buffer that they're kind of stranded.
Great. Yeah. Thanks for clarifying and giving some examples to that, Kyle. So currently we don't have any other questions coming in. We got through them all, which is great. We had some great questions really coming through too. So, which is awesome. So, I'd first like to thank Kyle for taking some time with us today to go through the second-time homebuyer course. It was an amazing wealth of knowledge Kyle provided here. If you're seeing this information and you think, hey, like, oh, my partner, a family member, a friend, hey, he could benefit from this, or they could benefit, she could benefit from this. We're going to be doing a lot of replays over the weekend, so tomorrow and Sunday. It's not too late for them to register. They'll get the link. They'll be able to come in and join that session as well. We have quite a few sessions left today as well. Our next one's going to be coming up at 2 p.m. Eastern, so just shy of 40 minutes here. We're going to be doing an investing in real estate course, which is really going to be a great one with another one of our UMortgage loan originators. So one more time, I'd like to thank Kyle. I'd like to thank all of you as well for attending here. Thanks so much for being here. We look forward to seeing you again for other sessions and hopefully further iterations of Financial Literacy Week. So thank you, everyone, and have a great day.
Thanks, Ryan.